Good afternoon, everybody, and welcome to our webinar for e-commerce and VAT. And this is going to be regarding the 2021 changes that are coming into effect next year. So thanks ever so much for attending today's webinar. My name's Lauren Trigwell, and our co-host is Andy Spencer, so he's joining us as well this afternoon. And just to run through what we're going to be going through this afternoon, I'm just going through a short agenda just now. And just to say, before I go through the agenda, please feel free to ask questions throughout. We are going to be offering a live chat throughout today's webinar, but also have specific questions to be able to be answered at the end. So do feel free to speak to us. We'd love to hear from you. In terms of the agenda then, so first of all, we're going to talk about how did we actually get here. So we're going to give you an overview of the rules to date, just so you could have got a real understanding of the context. And then we're going to give you an overview of the changes that are coming into effect next year. So telling you exactly what US is and talking about how US is actually going to work in practice. We're going to be talking to you about the implications for businesses, so both from a commercial perspective, a technical perspective, and for things that you really need to be thinking about. And we're also going to give you an update on Brexit and us and how these two things interact with each other, because they do coincide this year. We'll give you a latest update from the EU Commission in terms of us and things that you need to be aware of. And then in summary, we're going to be telling you the key actions that you need to consider and how we can, of course, help you, support you through this change. We are going to be having some poll questions throughout to keep it interactive, so do feel free to answer those. That will be really helpful for us. So let's get started, and I'll hand over to Andy to tell us how we got here.
Thanks, Lauren. So as Lauren said, we're going to start with how did we get here, because it's often useful to understand the context of the position so that we can understand what's going to happen in the future. So the single market was introduced in January 1993, and the idea was that businesses should be able to trade freely anywhere within the single market as if they were trading in their home country. So it removed the customs borders at that time, so you didn't need to make any customs declarations. Goods didn't need to go through customs checks. So it was simple, in theory, to be able to sell goods all around the EU. From a VAT perspective, the intention was that there was going to be a VAT system which was based on origin. What that means is that the VAT would be charged by the supplier at the appropriate rate in their own member state. So they'd only need to be registered for VAT in one place. That wasn't possible at the outset in '93, so what was introduced was a transitional system, and that's the system that we're still using now, 27 years later. So it's a very long transitional period. It was decided in 2016 that the origin system wasn't feasible for a number of reasons, partially because of the non-convergence of VAT rates and also other political and economic reasons. And the EU moved to formally adopting a destination system when it introduced the action plan for VAT in 2016. So the EU action plan had 4 different elements. The one which we're going to be talking about today is the first one, which is removing VAT obstacles to e-commerce in the single market. In line with removing those obstacles, there was also an SME VAT package, which was for small and medium enterprises seeking to reduce the burden that VAT can place upon them. There was also measures in relation to tackle the VAT gap. So the VAT gap, the latest VAT gap was 137.5 billion euros across the EU. And the VAT gap is the difference between the amount of VAT that should be collected based on the level of supplies that are taking place and the amount of VAT that is actually collected. So that 137.5 billion is 11.2% of the total VAT revenue that should be collected. So it's a really significant figure, and there's been constant efforts over the years to try and reduce that figure to a more manageable amount. So some of the initiatives that were introduced were improving cooperation between member states and also between EU and non-EU countries, having a more efficient tax administrations and putting in more reverse charge mechanisms, etc. The changes that we're going to talk about today are a first step in a longer journey towards a robust single European area. So the idea is that there will be a single VAT area, and there's going to be a definitive VAT regime for cross-border trade. That's due to have further changes in 2022, where there's proposed to be a one-stop shop for intra-EU B2B suppliers as well. So we can see that the way that the EU is moving is towards this concept of a one-stop shop, which we're going to be talking about in detail today. And the final aspect was in relation to modernising VAT rates policy. So at the moment, the EU is very strict in relation to how member states can apply anything other than the standard rates, so reduced rates, etc. The idea is that member states will have more freedom in the future to set VAT rates for their own fiscal policies. So that's the action plan. That puts into context the sort of the framework of where we are. If we have a very quick look at the current distance selling rules, so we're not going to spend long on this, but at the moment, the principle is that when a business starts selling cross-border on a B2C basis, it accounts for VAT in its own member state until it exceeds the distance selling threshold in the member state where the goods are delivered. So what that achieves taxation based on origin. And for some businesses that don't have significant levels of sales, that's all they'll ever do. They'll never have to register in other member states. And it can be seen that that way of taxing doesn't achieve the aim of the Commission to have a VAT system which is based on destination. So that's why we need to make some changes. There's also a distortion of competition in that if a business accounts for VAT in its own member state because it hasn't exceeded the threshold, the member state of consumption, where the final customer is, doesn't get any VAT. So there's a distortion of competition. So at the moment, using the example that we've got here, so a business in France selling goods to German customers and delivering to those customers and also selling to Italian customers would have to account for German VAT and Italian VAT respectively on German and Italian VAT returns. So they'd have to be registered in those two countries. Any other countries where they're below the distance selling threshold, they wouldn't have to register and they would continue to charge French VAT. So we have situations where some businesses have to be registered in all member states because the level of their sales is such that they've exceeded the threshold everywhere. And that then can obviously create a significant compliance burden, both in terms of the administrative time and effort required, but also the financial cost in having to register for VAT and account on an ongoing basis. That creates issues with non-compliance due to cost and complexity. And essentially we're left with a system where the VAT system hasn't evolved in line with changes in technology and business practice. So that's where we are today, and that's why we have to move. The EU have looked at how those obstacles being removed are going to benefit people, and they consider that there's three different ways in which there's going to be a benefit. So businesses, as we've just mentioned, will benefit from a reduction in cross-border compliance costs. That will facilitate greater cross-border trade, so you don't need to worry about having to register and increasing costs if you're selling to all member states. EU businesses will be able to compete on an equal footing with non-EU businesses that are not charging VAT, and this relates to a change in relation to low value consignment relief, which we'll talk a little bit more about in a moment, but which creates a distortion of competition between EU and non-EU businesses. And finally, member states will gain through an increase in VAT revenues of they've calculated as €7 billion annually. So it can be seen as significant amounts of money involved. But we're now going to start with a poll question. So how much do you know about OS at the moment? So you're fully aware of the details, but you want to understand the practical implications. You've heard of it, but you're not really aware of the details, but you hadn't heard of it until you accepted our invitation to this event today. So if you could answer that question, please. We'll give you a few moments to select the appropriate option. Okay, so we'll now publish those answers. So yeah, so most people have heard of it. Quite a few people haven't heard of it. So it's a mixture of, and there has been some publicity, but obviously that's why we're here today, to make sure that we can explain to you what the implications are and how it affects your business and what you need to think about for this significant change going forwards. Right, okay, so we'll now move to give you an overview of the changes. So, as we've said, the changes are going to happen in relation from 1st of January 2021. And what's going to happen is that the place of supply rules for intra-EU B2C supplies of goods are going to be changing. So there is a threshold, which is an EU-wide threshold of €10,000, and that will replace all existing country thresholds. So at the moment, the 35,000, 100,000 individual country thresholds will all go, and there'll be an EU-wide threshold of 10,000. That will apply to all B2C supplies of goods and services. So not just goods, any services. So at the moment, any service where the place of supply is in the other member state, that's going to be subject to that €10,000 threshold. Once you've exceeded that threshold, for goods, the place of supply of delivered goods is where the transport ends. So for anybody that's registered in one member state at the moment above the threshold, this means that they're going to exceed the threshold going forwards, and the place of supply will be wherever the transport ends. So if you deliver to all member states, the place of supply is in that country, and you have to account for VAT in that country. So you could have a situation where you're going from having to account in one other member state to 27 other member states. So significant change for some businesses. If you're registered already in all member states, the position will continue going forwards. So I mentioned a moment ago the low value consignment relief. The EU is going to remove that facility with effect from the 1st of January 2021 as well. Low value consignment relief is where goods being imported from outside of the EU below a threshold of up to €22 can be exempt from VAT. So it was introduced to try and effectively remove the burden for tax authorities having to collect what would be low amounts of VAT on individual consignments when they're being sold to private individuals. But what's happened is that the advent of e-commerce has meant that there's a distortion of competition. So there's not a level playing field for EU and non-EU businesses, and there's also a lot of value shifting as well, or false reporting of value. So they've realised that they need to remove low value consignment relief in order to be able to ensure that EU businesses compete equal footing with non-EU businesses. So we can see from the changes in the EU-wide threshold. So as I mentioned, that's across the EU as a whole, rather than per individual country. So that's going to result in a requirement to account for VAT in lots of other member states. So some businesses it will be the same, but lots of businesses it will be a lot more compliance burden. So to mitigate that, what the EU have done is that the current mini one-stop shop is going to be extended. So it's going to be for to a one-stop shop, which is going to be for goods and services. So what we'll do now is we'll look at the different variations of OS. So we're going to have a union OS, which is going to be for suppliers of B2C goods, supplies by intermediaries, and we'll come on to that a bit later. That's where you're using a platform to make sales, and also EU businesses supplying B2C services. There's a non-union OS, which is for non-EU businesses supplied in B2C services, and that's essentially the same as the current MOS, which is for telecom, broadcast, and electronically supplied services. And there's also going to be an import OS, and that's for imports of goods into the EU below €150. There's a few other definitions which are going to be introduced. So we're going to have the concept of the member state of consumption. That's the place where the VAT is due. So if it's for goods, it's where the goods are delivered to. For services, it's where your customer is established. VAT returns, the one-stop VAT return will be filed in a member state of identification. For EU companies, member state of identification is where their business establishment is. If you're a non-EU company with no EU presence, branches or offices, etc., you choose the EU country you want to be the member state of identification. Okay, so if we then look at OS in practice, So if we look at the union OS to start with and look at with an example of goods. So this is the same example that we looked at previously. So when we looked at this, there was going to be a requirement to account for VAT in Germany and in Italy and be required to be registered in those countries. Because we're over 10,000 EU-wide, there will be a liability to account in all of the countries to which sales are being made. So in this example, we're selling goods to 5 countries. We'd have to account for VAT in all of those 5 countries. But the other side of the situation is that we can use the one-stop shop return. We can use the union OS in order to account for that VAT in Germany, Sweden, Romania, Greece, and Italy. So it's going to be a bigger burden in terms of charging VAT to customers, but potentially a more simpler way of being able to actually account for that VAT. Okay, so that's the union OS. If we then look at the non-union OS, so this is for non-EU businesses providing B2C services. So total sales there of 32,000. That would then require VAT to be accounted for in Germany, France, and Italy, and that would then be submitted through the non-union OS return in the member state of identification. So whichever country the US business decided it wanted to be registered. So finally, we'll look at the import OS. So this is, as I mentioned, only for goods below 150 euros. And the reason the 150 euros is important is because that's the threshold for customs duty. So customs duty is potentially due on goods above that value. So if you've got, this uses a UK business on the basis that the UK has left the single market and the customs union by 1st of Jan 2021. So for any goods that are below 150 euros, to Germany, Sweden, and Italy, the VAT can be accounted for on the import OS return. And the way it would work is that the import of the goods into the country would be free of VAT, and then the VAT would be accounted for by the supplier, charging it to the customer, and then paying it to the tax authority on the import OS return. We'll come on later to what happens if the goods are above 150 euros. So that's the 3 different versions of OS. So if we can have the second poll question. So if where you deliver goods from outside the EU, and if in this we can include the UK, is your average order value always below 150, sometimes below, or never below? And it's not individual items, it's what would be in a package. So if we can have a go at that one, please. Okay, so thank you for that. We'll now publish the results. So yeah, so there's sometimes there's a mixture, which is to be expected. So unless you've got relatively low value goods, sometimes customers are going to order multiple items. So what that indicates is the import OS will be available for some of the time, but it's not going to be the total solution for most businesses. Okay, so now we'll look at sales made via a marketplace. So this will be people like Amazon, and there's significant changes being made where sales are made via this medium. So these changes apply when the marketplace facilitates the sale. And the definition of facilitation is when the marketplace controls the terms and conditions, authorizes the charge to the customer in respect to the payment, and or delivers or orders the goods. So it's where they've got an active involvement in relation to the sale. Doesn't apply if the marketplace is only handling payment, advertising, listing, or redirecting to a seller's website. So you need to understand the context in which the marketplace is acting, but if they meet those conditions, they're considered to be facilitating the sale. So the marketplace rules impact certain transactions. So any imports of goods into the EU below 150 euros, that's either from an EU or a non-EU seller. So the origin of the goods is the key thing here. and also cross-border or domestic sales by non-EU sellers. So essentially what they're trying to do is the tax authorities are trying to make sure that they've got somebody they know who is going to have responsibility for that VAT, and it's not a non-EU seller or where the goods have come from outside the EU. The way it's going to work is there's two sales. There's a sale from the business to the marketplace, and then from the marketplace to the final customer. The sale from the business to the marketplace is going to be exempt with credit. So that means any VAT that's incurred can be recovered. And then the marketplace has got the responsibility to account for the VAT on the sale to the final customer. So the marketplace is the one that's actually charging the VAT to the customer. So if you do use marketplaces, you'll need to review how you interact with the marketplace and what is the need for ongoing VAT registrations. And we'll come on to that in a moment when we look about the interaction between OSs. Okay, there's also a further complication in respect of if you hold stock in the EU in a country outside of your own member state, or if you're a non-EU business, you hold stock in a country within the EU, you'll need to take account of the location of those warehouses. So if you're an EU business, so for example, you're a French business, OS only applies to cross-border sales. So if you're making sales to French customers, you'd account for that under your French VAT return. And what that means that if you've then got a warehouse in another country, cross-border sales from that warehouse can be declared through OS, but if you've got local sales, they need to be accounted for through a local registration. So you may need ongoing VAT registrations depending upon your exact profile. You might also need to be registered for other reasons. For example, if you do sometimes make B2B sales, make acquisitions. So the introduction of OS is one element, but it needs to be understood in the context of the business's whole supply chain. So you need to review the supply chain, taking into account the specific circumstances of your business, and also understand that supply chains are constantly changing. So as things change, you need to think about making sure that any obligations you've got are continually reviewed. Okay, so I mentioned about the interaction of OS and VAT returns. So and the fact that an EU business will require a normal VAT registration, and that it'll also apply where they've got a warehouse in another member state. For non-EU businesses, and this will include UK businesses, if at the point that the OS changes take place, the UK has left the EU. So we've ended the transition agreement and we've left the EU and no longer part of the single market and the customs union. For EU businesses, you can potentially have a range of different options. So for example, you could have an OS registration for intra-EU B2C sales of goods. So that's where the goods go from one member state cross-border to other member states. You could also have an import OS if you, for example, sent goods from the UK to customers within the EU and those goods are below 150 euros. You need to consider VAT registration if you're selling goods which have been imported above 150 euros. You also need registrations if you've got a warehouse for those local sales, because you couldn't use that, and that would typically be a third-party warehouse. Otherwise, if you had your own warehouse, you wouldn't be considered to be a non-EU business for this purpose. And then also the last aspect, if you provide B2C services, you could also have to use the non-union OS as well. So it can be complex, and it's key to understand exactly how everything is going to interact in terms of not only where should you charge VAT, but how are you going to account for it. Okay, so if we do a further poll question, so have you currently got a warehouse outside of your home country? If you could answer yes, no, but you're planning to set one up before 2021, no, but you're planning to do it afterwards, or no, and you've got no plans to set it up in the future. Okay, so thank you for that. So the results that more than 50% of people have got a warehouse already. Some plan to set one up next year, but there's still quite a lot that don't plan to have any in the future. So it's a sort of mixture between yes, you've already got one, or no, you're not going to have one in the future. So thank you very much for that. So that's given a brief overview of some of the technical aspects, and I'll pass you back to Lauren, who's going to now talk about the implication for businesses.
Thanks, Andy. So I'm sure there's lots there to digest. Perhaps some of you didn't know all of that, some of you were aware, but I'm just going to now talk about some of the practical implications for you as a business and the things that you're going to need to consider and start thinking about ahead of the changes. So first of all, it's important for you to know that OS is not compulsory. You can continue to be VAT registered in applicable member states. Perhaps you've already got VAT registrations at the moment. You can just maintain that current position and think about other VAT registrations if that makes sense for your business. So you're going to have to make a decision on whether to use OS, and hopefully this webinar is going to be really informative for you to think about whether it's going to be good for your business or not. If you are considering OS and you do think it's a route that you're going to go down as a business, you are going to need to make a transition. And some of the things that you're going to need to think about is, first of all, you will need to register for OS. So you will actually be able to register for OS from October 2020. So although the rules come into effect from the 1st of January 2021, you can register as early as October. So it's an important timeline for you to be thinking about. As Andy says, you're going to need to think about your system changes, because you're suddenly going to need to account for VAT in many more member states than you currently are, which is going to have significant system changes, perhaps to your website, to your IT, to whatever ERP system and e-commerce system you are using. Certainly for many businesses that have different VAT rates with their product line, you are going to need to consider the correct VAT rate to apply, because you're going to suddenly need to start charging local VAT in many more member states than you currently are. So you do need to consider perhaps if a reduced rate applies or not. VAT rates are all different throughout the EU, and they differ between countries and also differ depending on the product. So it's an important thing that you're going to need to consider. And should you do want to register for OS, you will also need to cancel your existing VAT registrations that are no longer required. It's not yet confirmed whether you'll deregister in the normal way, but you wouldn't need to have the existing VAT registration that you currently have. So just moving on to start thinking about some of the commercial implications that you're going to need to consider. One of the huge things that businesses are going to need to think about is pricing. You're going to suddenly need to start charging local VAT for all countries across all the EU, and VAT rates are different across all countries. So pricing is going to be a huge area that you need to consider. Perhaps you're based in the UK, and the UK VAT rate is at the lower end of the range, and there's many more countries that have higher VAT rates, such as Luxembourg. So there's going to be lots of things that you need to think about in terms of, from a pricing perspective, whether your current margins make sense now. You're going to have to think about where you are established, where your home member state is, because if you're going to have to increase your prices, it could have an impact on your home market. It could perhaps make it more expensive, which obviously potentially could mean a loss of revenue in your home market. So there's lots of things that you're going to need to consider. One route is to have, and perhaps the optimum route for many businesses would be to have differential pricing, and this would be based on the location of the customer. So your IT software is able to detect where your customer is based and have a different price package. The reality of that is that it's quite difficult to achieve in practice. Not many of our clients have adopted that. It's quite difficult to implement that. It takes a lot of investment from an IT perspective, so that might not be the optimum way to look and to set up your pricing. So there's going to be quite a lot to think about from a pricing perspective that you're going to need to consider. And lastly, just from a retrospective point of view, many of our clients have retrospective obligations, and they often approach us needing to declare historic VAT that they should have declared. OS is going to give tax authorities visibility of sales in all your member states. So from the 1st of January, you will have to declare all sales from all countries. Of course, where you've currently been VAT registered, it doesn't create an issue, but perhaps you're suddenly going to have to start declaring sales in certain countries that you were over over previous distance selling thresholds in previous years. This is very likely to alert tax authorities to detect that you probably should have been VAT registered historically and you haven't. So this is going to be an area of risk that you're going to need to consider, and certainly if you know you've got liability in some countries as to now, we do recommend looking at your position in all member states, particularly where you aren't currently registered. We want to encourage all of our clients to remain compliant, make sure that they are looking after their VAT obligations. And we do know there are sales peaks throughout the year, and obviously with the 1st of January, it will be just after Christmas, which is tends to be a specific sales peak. We find in our experience that generally proactive voluntary disclosure is preferable to tax authorities rather than the other way around. They're more likely to have a more pragmatic conversation with you when you're disclosing it to them rather than the other way around. And we have noticed in the last few years, as Andy's been saying, tax authorities are getting stricter on non-compliance, and they are proactively looking at ways to detect breaches. So as Andy gave all the context, OS is all part of trying to close the VAT gap. It's trying to detect more companies that aren't compliant. So we do want to make sure that if you do have retrospective obligations and you are worried about certain countries, or you will have exposure in some countries, you do need to look at those countries prior to OS. Moving forward, if a company was to approach us and they have historic VAT that they need to declare, the mechanism for correcting that position will be via the existing distance selling regimes. You will still have to register retrospectively in each member state, but of course moving forward from the 1st of Jan, they will be able to adopt the OS mechanism. So there's lots of things there that businesses need to think about, and that you will start thinking about now in order to work out whether OS is the optimum thing for your business. So I'm now going to hand over to Andy to talk about Brexit and OS and the interaction of both of those as well.
Thanks, Laura. No webinar on VAT would be complete without talking about Brexit. So we're just going to talk about the interaction between the two. We'll start with the current UK status. So as we mentioned earlier, the UK formally left the EU on the 31st of January 2020. We've entered into a transitional period which remains in place until the 31st of December 2020. Government has introduced legislation to say that transitional period will not be extended even if there's no free trade agreement with the EU. So the anticipation is that until the end of 2020, but no longer, the current EU rules on VAT will apply. So that's why the distance selling rules, as we've talked about at the moment, continue to apply, and the UK will remain in the single market in the customs union. So I don't think it's generally expected that there will be any change to that position. So that's where we are at the moment. If we then look at the current government's position, so during the course of last year, there were a number of trade facilitation measures which were introduced. So this was before the current government came into place, and some of those things were in relation to postponed accounting for import VAT. So that was recognising that when goods are going to come into the UK from the EU, there's going to be a need to account for import VAT. That needs to be paid to the tax authorities, can be recovered, so it's not an ultimate cost of the business, but it would create a significant cash flow hit for any businesses because they're used to not having to pay VAT because they account for acquisition tax whilst the UK is within the EU. So that postponed accounting effectively would mean that VAT would be accounted for in the VAT return rather than having to physically be paid to customs. There was also going to be transitional simplified procedures for imports, which was going to make it much easier to bring goods into the UK, so there wasn't going to be a need to make detailed declarations at the time they arrived. Now, the current government withdrew the guidance which had been provided by HMRC on the 19th of February 2020, and if you remember, that was around the time that Michael Gove spoke about their current position is that we're in a transitional period at the moment, so there's no need for these previous measures to be in place. So because businesses have got until the end of 2020 in order to make the necessary preparations. So in relation to customs declarations, there's time to put in place the necessary procedures. So we've spoken to customs recently on this because it's still not entirely clear what what customs are going to do. At the moment, their position is they're saying, well, none of these things are going to apply in the transitional period, but it's unclear whether any of them will be introduced in the future. I mean, at the moment, based on what Michael Gove said, is it would seem that they're not going to introduce postponed accounting, and some of the other narrative from the government is that they want full customs declarations to be made, because we're going to be, the UK is going to be a third country, so it'd act in the same way as any other third country. So that will potentially evolve over the course of the year, but we need to think about what impact that is going to have on us. So there's a couple of aspects to this. One is in relation to sales to the UK of low value goods. So we talked about low value consignment relief being removed by the EU. The UK have also got low value consignment relief, and it's for goods below £15, which are imported from outside the EU. There are some restrictions. So for example, goods from the Channel Islands aren't covered because there was what the government considered to be abusive practices in the past, where goods were shipped to the Channel Islands, then imported back in again using low value consignment relief. So that was creating distortion of competition, so that was removed. But for other countries, there is a low value consignment relief. The government previously announced that they were going to remove that when the UK leaves the customs union, again to deal with this distortion of competition point, and they passed legislation for a special scheme for goods below £135. So that was going to be a similar scheme to the import OS within the EU, and basically would mean that rather than having to pay the VAT at the time of entry, it would be paid for by the supplier. Now, we spoke to customs about this earlier in the week, and it's not clear whether that's still going to go ahead. They weren't able to say at this point, but my own view is that it's likely that something will be required in that vein for the same reason as the import OS has been introduced. If low value consignment relief does go, there needs to be a simple mechanism in order to be able to collect all that tax. The other aspect is when goods are leaving the country. We touched on this briefly before. So one of the big challenges for UK businesses when the UK was potentially going to crash out was what to do with regard to goods being sent from the UK to customers within the EU, because the distance selling rules would no longer apply. So you would have an export from the UK and an import into the other member state. So as we've mentioned before, the import one-stop shop provides a solution for packages below €150, but what our poll showed was that actually that's not going to apply in all cases. So there still is a need to consider how to deal with goods which are going to be above €150. So there's a number of potential options, including an EU warehouse, which some of our clients have set up in order to deal with sales to EU customers, importing goods into a single member state, and then potentially using the one-stop shop from there. So but all of these options have got the potential for additional VAT registrations to be required, and businesses will need to plan accordingly to make sure that they understand what's available to them and how they can put those options into practice. Okay, so just a quick question on Brexit. So what preparations have you started to take ahead of Brexit? So none at all, some, but you're waiting for the final position to be confirmed, i.e. what the free trade agreement with the EU is going to look like, or yes, you're fully prepared. So I'll give you a few moments to deal with those questions, that poll. Okay, so thank you for that. So most people have, well, 69% have made some preparations, but waiting for the final position to be confirmed, but nearly a third have made none at all at the moment. So it does, I think there has been it's been really difficult for businesses to know what to do, given the lack of clarity about where we're going to end up. So it is something that you need to think about, and it's something which we can obviously help to assist you with. And the fact that the one-stop shop and Brexit do coincide potentially makes it easier for businesses to be able to manage the transition going forward. Okay, so we'll just now cover a few recent updates. So as you'll appreciate, things change all the time. We'll talk about a recent document which has come from the EU Commission. So this change to the one-stop shop has been in motion for many years, and the Commission has now introduced the last piece of legislation which is required in order to be able to for the one-stop shop to be effective. So that was issued on the 12th of February 2020. That's implementing Regulation 194. It sets out registration requirements and return information for the various versions of OS. So it says, what do you need to do to register? What information do you need to report? So there's a number of factors which it highlights in relation to the reporting of sales. So if you're using the Union OS, so for example, you're a French business whose member state of identification is France, but you've also got a warehouse in Italy from which you make cross-border sales, you'll need to split the cross-border sales between the French warehouse and between the Italian warehouse. So they need to be reported separately. So there's going to need to be a mechanism in order to be able to do that. If you're providing B2C services and you're providing them from multiple establishments, so for example, if you've got a French business and they've got a head office in France, but they've also got branches in other countries, they need to report those sales separately. And you'll also need to report in each member state of consumption at each applicable VAT rate in that country. So some countries have got multiple rates, so you're going to need to know, as Lauren mentioned earlier, what rate of VAT is going to apply to that country. So there is some complexity in relation to how the reporting has to take place, even though it's on a one-stop shop return. So there will need to be thought given about how you're going to meet those obligations going forwards. Okay, and latest from member states, so there was a question which said that there's been rumours that the introduction of the one-stop shop is going to be delayed. The way that we've been following this is that we've been in contact with the Commission over the last 18 months, 2 years. So we spoke to them at the end of last year. They said that from a legislative point of view, everything was going to be in place, and the real issue was going to be in relation to whether member states were going to be ready or not. They said that if they were going to delay it, they were intending to make an announcement by the end of 2019. There was no such announcement, so we're planning and preparing on the basis that it will be going ahead, but obviously things change, and the Dutch tax authorities have recently written to the Dutch government, so that was on the 27th of February, which was highlighting potential problems in them implementing MOS. So as is to be expected, it was in respect of the development of their IT systems and whether they were going to be ready on time in order to be able to deal with OS from 1st Jan next year. So the Dutch tax authority have undertaken to work with the Commission to investigate it further. They've given an undertaking to report back in summer 2020. Now, the context of the Dutch issue was there's some significant problems in some of the issues that the Dutch tax authorities have been working on, and this issue with the IT system came to light in the context of some of those other issues. So it's not entirely clear what will happen, but it is highlighting that there is a potential problem in at least one member state in meeting the IT deadlines. It's possible that there may be other member states which have got the same issues. Now that the Dutch have sort of raised the issue, it's possible that other countries will start to say, actually, we've got an issue as well. And there's going to be a significant issue for the operation of OS if one member state's not ready on time. So the way that OS returns are going to work is they're calendar quarterly. You have to submit them within 30 days of the end of the period. So you don't have to do your first OS return until April 2021. But the import OS mechanism is going to be required immediately on the 1st of January 2021. So the way it works is you'll get a number, you then put that on the customs declaration, and that effectively allows the goods to go through customs without any VAT being charged. So it's interesting to see that there are now reported problems with some member states, and we'll keep abreast of what's happening and keep you updated via stories on our website if there are any further issues that we identify. But it is a massive IT change for some member states, so there is the potential for it to be delayed.
Okay, thanks for that, Andy. So now I'm just going to talk about some of the key actions and actually how we can help support you through these changes. As I'm sure you've heard today, there are a lot of things that businesses need to consider in regards to OS. Some of you have had questions already, which we'll continue to answer. But I think, first of all, it's important to say that OS is intended to introduce a much needed simplification. As Andy said, they want to align this and make it simple for businesses moving forward, and ultimately they want to reduce the VAT gap. But unfortunately, the position, and as you've seen, is not simple, even though it is supposed to be a simplification. So it is going to require businesses to have careful planning and ensure that their obligations are understood, and also that you have the right systems enabled to be able to report OS in the right way. So it does have the potential to ease burden on businesses and also reduce the administrative costs of being VAT compliant. As Andy says, it's going to be a quarterly VAT return, and potentially you only need to submit it in one country, but it has got the potential to also create some significant issues if not managed appropriately. So we're going to be talking about shortly some of the risks and things that you need to be aware of a business should you want to adopt this mechanism. So some of the uncertainty that remains, like Andy says, there are changes all the time, and whilst we're keeping abreast of the EU Commission and what they're saying, tax authorities are also releasing further information, such as the Netherlands last week. So we are keeping abreast of that and will inform you as per any significant legislation does change. But there are some legislation that still remains quite unclear, and whilst they've given quite a lot of information, they're still yet to publish detailed guidance. So one of the things that they haven't really discussed is Intrastat. So in 2022, there's a simplification of Intrastat that they're wanting to put into place, which removes Intrastat arrivals. With OS coming into effect next year, they haven't yet clarified whether, if you are submitting Intrastat already, whether you will still have to report that in 2021. That's quite a big issue for a lot of businesses. Many businesses are over the Intrastat threshold, and it still is unclear whether you will not have to report that with OS or whether you'll still have to report this separately, which then becomes quite problematic. There are also supplementary declarations. Each country has lots of other declarations, not just VAT returns, that they want countries to report. So in Poland, they have the SAFTI reporting that they introduced a few years ago, which is a very detailed report that the Polish tax authorities like to see, so they have more information on any company registered for VAT in Poland. It's still not clear whether you'll have to still report this in the same way, or again, that OS will cover it and the tax authorities will be satisfied. So that is another burden to be thinking about. This is very similar to real-time reporting, such as SII in Spain that came into effect a few years ago. SII only affects you who've got significant sales into Spain, but it's again unclear whether, if you're already reporting on SII in Spain, whether you'll still need to do that moving forward after the 1st of January. So as I said, the EU have yet to publish detailed guidance on the operation of OS. So whilst they've disclosed the principles, there's still a lot of ambiguity as to the operation, and like the Dutch tax authority saying they may not be ready, that begs the question of the start date and whether they'll actually still go ahead on the 1st of January. It's been moved before, it could be moved again, so there is potentially options for it to be delayed, and we are keeping abreast with the Dutch tax authorities to see what their approach will be in the summer 2020. So as Andy says, we're preparing for it all to be in place for the 1st of January, but we're also open to the tax authorities not being quite ready. But of course, we'll let you know as that unfolds. So some of the risks that you need to be aware of that have been issued by the EU Commission is that the European Court of Audits has recommended audits increase for e-commerce businesses. So as Andy says, there's significant VAT gap which they want to reduce, and they're proposing that OS is going to have a significant positive impact to reduce this. So in light of this, in light of tax authorities wanting much more visibility of people's reporting and people's data, it's very likely that more audits will happen because they're going to have way more visibility on every single country. So it's a significant change that's going to happen, and we've seen over the past few years tax authorities increasing audits, so this only just is very a similar approach to what we expect the tax authorities taking. The tax authorities can also request detailed data to support the VAT accounting. So to file OS, you only need to report the VAT and the net amount, but the tax authorities can request transactional data. So we're going to still need to see your transactional data so we can make sure that everything's correct, but it's also going to mean from a systems point of view that you're reporting everything correctly. It's extracting all the information we need to make sure that this information is on hand. When the tax authorities request it, it's often at very quick time frames and very quick turnarounds. So you're going to need to be able to produce that information very quickly. It's also one area of risk is in relation to penalties. So at the moment, if you're VAT registered in a country and if you are late, you are very likely to be penalised for late payment penalties, and each country adopts its own mechanism. Once you're filing on OS, we're not sure if there'll be a multi-country penalty scheme that they'll adopt, or whether each country will still want to adopt its own mechanism. So potentially you could be, if you were to file late, you're going to be filing late and paying late in all of those countries. You could be receiving penalties from every single country in the EU, which is a significant risk and very different to EU businesses now. Another thing to mention is that repeated non-compliance. So if you fail to report OS on time and regularly, this will result in you being withdrawn from the OS scheme, and the default position would be that you would need to register in all country member states and become VAT registered individually again, which obviously removes the simplification. It's worth noting that if you are withdrawn, you wouldn't be able to reapply for OS for up to 2 years. So for at least 2 years, you would need to make the VAT registrations again, which again would be a significant administrative burden, but is something that you need to consider. So you need to be very careful, make sure that you are meeting these deadlines to make sure that this doesn't become a possibility. So how can you get prepared? So as Andy said earlier, particularly as Brexit and OS are correlating in terms of launching at the same time, it's really, really important that you understand your supply chain and how the OS changes are going to impact you. This is going to be really, really fundamental to your business and how you're going to post a plan. And this is really going to help determine where you're going to require ongoing VAT registrations and actually what version of OS will be required. Many of you have mentioned that you do a combination of different goods above 150 or lower than 150. Some of you use warehouses. So supply chains are becoming more complicated, and Brexit only just compounds that. So it's going to be really important that you have real clarity on your supply chain so we can help confirm what VAT changes and what VAT regimes you need to adopt. You also are going to need to determine what rates of VAT to apply to your sales in each member state. As I mentioned earlier, pricing is going to be a significant issue, and so you're going to need to consider VAT rates now across all of the member states, not just the ones that you're VAT registered in, which will take some research. Like I said, VAT rates do differ between every country, so you're going to need to have time to do that. And lastly, you're going to need to ensure that your e-commerce system or your accounting ERP systems are fit for purpose. There is a general trend to tax authorities for digitization. They do want more visibility in your data, and so we've now got time to prepare for OS to make sure you're investing in appropriate mechanisms to ensure that we get the right data from you, to ensure that it meets the EU Commission requirements, and that it gives a real life scenario based on what your supply chain is. So does it actually match the activities that you're doing as a business, and is it easy to extract as well? So how can we help you? Well, at Accordance, we are committed to supporting our clients through this change. And as your expert service provider, we'll obviously keep you informed of ongoing developments. So both from a UK and EU perspective, just like the Dutch disclosure last week, we want to make sure we're continuously providing you that update so you can plan accordingly. We want to help you prepare for us and Brexit so that ultimately you can continue to trade confidently in Europe. We want to make sure that you can focus on what you do best, which is focusing on your trade and making sure that VAT and all these changes is not a barrier to that chain. So we can support you. We can support you with supply chain reviews. We can also look at your data. Like I said, that's going to be key moving forward to make sure that your systems are going to be in line with reporting requirements and making sure that anything else that's needed, we can help embed that into your system. And ultimately, we can continue to facilitate your EU VAT reporting using the most appropriate mechanism. So whether that's the union MOS, whether that's the non-union MOS, or whether that's the import OS regime as well. So there's a lot that we've just gone over there. I hope that's been informative for you. So we're going to be finalising the webinar soon. We're going to have some questions, but first of all, we're going to have our last poll question. So do you think that OS is going to be a positive change to your business? So absolutely not. Possibly partly, but there still needs to be further information before I can decide, or absolutely, I can't wait. So we'll just wait a minute for everyone to give a vote and then we'll go through questions. So we're just going to get the results now. So 92% says partly, but there still needs to be further information before I can decide. Some of you can't wait for us, and some of you absolutely not. So of course, as further information comes from the EU Commission, we'll talk to you about that so you can feel like you can make more of an informed decision. Okay, I'm going to hand over to Andy now to finalise the question and answers that we've received as well.
Thanks, Lauren. So we've got time for a couple of questions. So if you've asked a question and we're not able to respond this afternoon, we'd be pleased to discuss it with you separately. So one of the questions is about occasionally making sales in a member state. So rather than it being a distance sale, it's from, for example, a temporary retail store, so like a pop-up shop. So the question is about whether you can use OS, or is it best to stay registered in that member state? So yeah, you can't use OS for that because it's not a cross-border sale of goods. So you'd need to be registered in that individual member state. There's also, you'd need to think about actually how did the goods get to that country in the first place as well, because potentially a movement of own goods, which even though it's not a commercial sale, it's a supply for VAT purposes. So if it's moved between two member states, there's need to think about that, and also what happens with the unsold goods once they go back to the original member state. So OS can't be used for that because it's not a cross-border sale, so you'd need to be registered, but there are ongoing complications in respect of that as well. So another question we've got is that in case you hold stock in another member state, are there also local laws that mean you need to get a VAT registration, or can what's coming from the EU be considered to be the truth? So the way that this works is that the Commission will publish the legislation. Member states then have to adopt that into their own domestic legislation. Some cases there's the wording in the EU directive is shall, so that's obligatory in respect to the member state. Sometimes it's may, which gives the member state an option. So most of what we've talked about today, that should be the treatment throughout the EU. So if the OS should apply in the same way in all member states, the rules in relation to whether you're making local sales or not should apply equally. The difficulty with VAT always is that there will be some instances where there's a deviation by a particular member state. That could be because of the way that the country's decided to interpret it. Could also be because the way that individual tax officers interpret it. So there is always an element of doubt, but the principle is that what's in the directive should then be implemented throughout throughout all member states. So I think there's a number of other questions, but unfortunately we've run out of time. So if you do have any questions, if you would like to get in touch with us, we will then be very pleased to talk to you about those and help you to navigate what is going to be a significant change for e-commerce businesses. So I'd like to thank you for your participation this afternoon, and have a good afternoon.